Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I'm Austin Wilson, co-portfolio manager at Hicks & Zerker Capital Management.
I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us with our podcast?
Subscribe if you're not subscribed already. That way you get new episodes when they drop. And this is even more important, as we'll talk about later.
Yes, surprise.
Subscribe for that. That'd be great. And leave us a review on Apple Podcasts, Spotify, wherever you're listening so that we can help more people. So today, we are wrapping up the year here. It's towards the end of the year. It's in the fourth quarter here.
Yes.
We are going to be discussing some year-end financial planning tips.
Yes, and that is right. We have 10 things that we're going to bring up.
Josh picked a great round number.
10, I like that. Good. No bonuses, just
No
10,
bonus.
straight 10. Things that you should consider at year end when you're looking through your full financial plan.
That's right.
I've talked in the past about like tax ideas at year end, and we'll get into a couple of those, but this is more of a broader look at your full financial picture, things that maybe you should consider doing at the end of the year.
Yep, absolutely. So, Josh, kick us off. Number
Yes.
one.
Number one is now is a good time to review your budget.
Yeah.
And look at how did you do in actual spending versus what you had planned for.
That's right.
And remember, life is life. Things change, stuff happens. So it's not going to be exact. So you got to look at that and say, okay, where did I overspend? Is this something that I need to plan for next year's budget? Is this something that will happen again? Or was this kind of a one-off thing where, my water heater went out, so I had a lot more home costs than I normally do. I don't anticipate that happening next year type of thing. So,
Absolutely.
Review your budget, and that's where then you start looking forward to the next year and doing your planning to say, okay, I said I was going to spend X amount of dollars on groceries. How did I actually do?
Yep.
Do I need to tweak that for next year? Prices are more, or I'm feeding more mouths, those type of things. Adjust your budget.
Well, it's probably also to the point where you're getting to the time of the year where you'll probably have like a performance review, compensation review with your employer.
Yep.
So you may have an understanding of what your income will be next year.
Right.
So you can adjust your savings. 50-50 rule. Go back and listen to that if you don't remember what that is. Or your budget for the next year, knowing things probably will be just a little bit more expensive year over year. So kind of factor that in as well. But yeah, you should have some more clarity on what's going to happen.
And, while you may be tweaking your budget throughout the year, a good annual review is always nice just to get a big picture. Because again, if I look at my family with 4 kids, in the summer when they're home, our expenses look a little different than during the school year.
Right.
When they're at school, they have different costs between those different time frames. So just getting a big picture gives you a better feel of where you're at and then what you need to do in the future years.
Number two.
So along with that, and you mentioned your performance reviews or end of year reviews at work, along with that is healthcare. So let's say you are in a plan that your company sponsors. You don't really have a lot of choices, and not like you go out and shop those things. But for those type of things, review what all benefits they offer.
Yeah.
Because a lot of companies have your healthcare plan, but within there are additional benefits. Like maybe you get a free eye exam every year or every other year. Well, make sure you utilize those.
Absolutely.
You're paying for it. You might as well get those things in there. Another thing to look at with your healthcare is maybe you get a bonus or a discount if you do certain things every year. I know there are some plans that if you get a annual physical or an annual exam, they will give you either a deduction or give you straight up money back as a reward for maintaining or staying healthy along the way.
Look into that.
Yep. And then on the other side, if you're on private healthcare or you're in retirement and 65 and on Medicare, end of the year is when there's open enrollment. So this is the time to review which healthcare plan you have and say, is this still the best plan for me? So I'll take the Medicare group. Medicare is your primary source. There's A and B. We've talked about that in some other episodes. Most people have some supplemental plan that covers the things that Medicare doesn't. End of the year is when you get to review that because it's a 1-year agreement. You don't have to stay with them forever. And so if you have new prescriptions or something changed in your health, that's a great time to look to say, is this still the best plan for the things I'm going to use it for? And then if you're on private insurance, same thing. Did the cost change? Is there a better plan out there? Am I utilizing this? Do I need a higher or lower deductible? Where's my situation work? So healthcare, end of year, not only is it a good time to do it, but this is actually the window for a lot of people to actually make changes.
That's true. Number 3 is my favorite, Josh.
Yes.
Maximize or look at what you have left
Yes.
before you can maximize your contributions to your various investment accounts.
Yes. So every year there is a limit to how much you can put in retirement accounts, all the way across the board, from 401ks, simple IRAs, Roth IRAs, traditional IRAs.
These are moving limits, by the way.
Yes. Every year
Just
they
about
adjust.
every year they move.
But the thing is, you can't do more than that.
Yep.
You could do less than that, but you can't ever go back and make up for prior years. And so before the year ends, and there's a little asterisk here because like Roth IRAs and traditional IRAs, you actually have until April of next year to actually make the contribution. But end of year is a good time to sit down and say, okay, how much did I plan on saving? Have I met those goals? Do I have any extra money that I'd like to save? And again, that comes back to your financial plan. What am I trying to achieve? Is this the best place to put the money? So, those are all things you got to think through. But couple, just so everybody knows, Roth IRAs, traditional IRAs, the limit is $7,000 for 2024. If you're over 50, you get an extra $1,000, so you get $8,000 contribution. They call that a catch-up contribution. HSAs, that's another one where you have a limit, $4,150 for single and $8,300, which is just double that for a family plan. If you're over 55, you get an extra $1,000 catch-up for that as well. And those you have to be in a high deductible plan to do an HSA. So make sure you're eligible for that one. 401k, the max for that is $23,000 of your own money. That doesn't count the match. And if you're over 50, you get extra $7,500 catch-up contribution there. Simple IRAs, which are another type of company retirement plan, is $16,000 with people 50 and over getting $3,500. So just those are some limits. You can Google them if you don't want to go back and listen to this when you're actually looking it up. Very easy to find. The IRS has a table on all those amounts. But that's the thing to think of is, what am I trying to do with my plan? In retirement savings, because of the tax structure, those are usually the most efficient way of saving for that goal. So make sure you're utilizing those as you can.
And one thing I talked about earlier was maybe you're looking at end of year performance reviews, end of year yada, yada, yadas. Well, what also happens at the end of year sometimes, depending on where you work or how your pay is structured, bonuses.
Yes.
And this is a great use of bonuses.
Mm-hmm.
Like A, yeah, you should have some fun with it. B, you should pay off debt if you have debt, especially high interest debt. But C, look at the amounts you have left on some of your various retirement accounts or various investment accounts that are tax advantaged like these, and look at shoving some more money into those.
All right.
Number 4, Josh.
Number 4 is
my least favorite.
Yeah, tax loss harvesting. Austin and I have a thing about this, or gains harvesting, which I'll talk about the difference between those two here. But in taxable accounts, for the year, the calendar year, you can offset, mitigate, or create taxes by selling investments that are in taxable accounts. So an example, you buy a stock for $10. It goes up in value to $13. That $3 it moved is new money you didn't have. That's gains. Until you sell it, it's called unrealized gains. It could go up or down.
At this point, it's not taxable.
Not taxed
until
yet.
You sell.
Yep. When I do sell $13, I owe tax not on the 13 because that 10's already been taxed before. The $3 is taxed.
Yep.
And depending on what tax bracket you're in, you could pay 0, 15, or 20% tax on that capital gains. And so the idea there is, because there's a range from 0 to 20, you may want to either reduce that tax or create more tax, because although it's taxed at 0%, you don't pay anything.
Correct.
And
so this is where you need to play the game with where your income is.
Yes.
Maybe your income is going to be under the threshold where you have no capital gains tax for a year. You may want to incur some gains while you can, instead of maybe the next year your income will go up above the threshold, and that's a hard line.
Yes.
So if you're $1 above the threshold, your tax bracket is the new bracket. It's not tiered for your capital gains.
Right. But it's only on those new dollars.
Yep.
But yes, it goes from 0 to 15. It doesn't go 1, 2, 3, 4, 5 all the long way up. And those dollar amounts are, and this is your total taxable income. If you're single,
AGI.
If you're single, $47,025.
Love that 25.
If you're married, $94,050. And so, just rough numbers, 47 or 94 are the numbers. If you're below that and you have investments that are in taxable accounts, even if you're not planning on needing that money, sometimes just selling and utilizing, and you could actually buy those back right away because you don't have losses.
Yes.
You could just reset your cost basis back to a higher level and not pay any capital gains. So that's gains harvesting. Tax loss harvesting is where you say, I have an investment I bought for 10, it's gone down to 7, I lost $3. Again, if you don't do anything, that's unrealized.
Correct.
But if you sell, that $3 loss is a reduction against other gains. Or if you don't have any other gains, you could take up to $3,000 against your income. So there are people at the end of the year who, even though they may still like that investment, say, just timing wise, it's down. I'm going to sell that. I'm going to take those losses, offset other gains where I got them elsewhere just to bring my taxes down. Wait 30 days, 31st day, I can buy it back.
Yep.
Or I could buy something different.
Yep.
It can't be the same. You got to buy something different while I'm waiting.
Absolutely.
So there's tax things you can do at the end of the year. Now that's a calendar year. Once January 1st happens, you lose that opportunity to offset any gains.
Absolutely. Yeah, it's definitely one of those timing games you have to play. And if you do it correctly, you can save a lot of money on taxes because the bigger your asset pool gets, the bigger these dollars can get, and they can get out of hand.
Yep. Now, the way we joked at the very beginning, Austin is not a fan as an investment person who's building portfolios. He may like that stock and says, why are you getting rid of it? I really like that one. But, it's a trade-off between managing and mitigating taxes in any calendar year versus a long-term investment strategy. And you can't let one override the other. You got to look at them together. And that's, the best way of managing the money.
And it's actually interesting. You can look at the years and how the markets move at what your opportunity levels are as well, because this year markets are up pretty big. Most stocks are up decently.
Yep.
There are some losers, but not a lot.
Yep.
Fixed income's up. It's all up. So not a great year to be locking in a ton of losses.
Yep.
However, something like a 2022, oh my goodness, you could have tax loss harvested for days. And there are also some provisions for carry forward.
Yes. So if you don't use it up, you can use it in future years, which is a great way to say, all right, in a down year, I'm not happy. My portfolio is down. It's not gone well. But you know what? I still believe long-term it's going to go well. So I'll sell and harvest some losses. So in future years, when I know things are going well and I have gains, I can bring those taxes down. So that's one. Number five. Charitable donations. So this is another one. Yes. And we see a lot of this at the end of the year. If you are involved with nonprofits, a lot of times at the end of the year, they'll do a lot of just asks saying, hey, if you're wanting to donate, we'd love to be on your mind for that. And the reason for that is again, a calendar year, if you're trying to mitigate future taxes for that year, you can do that through donations. And there's a couple ways of doing this. One, if you're going to itemize your deductions versus standard deduction, charitable giving is one of those itemizations. And so if you're going to be above kind of the $27,000-ish threshold on your total deductions, you can put more charitable in every dollar you give to charity above that, you can deduct your income. And so there's what's called lumping, which is to say, hey, I usually give, let's say, $15,000 a year. Well, I could give 4 years worth. I could give $60,000 into a donor advised fund or to a charity or however you want to do it.
Take the whole deduction this year.
And so anything above that 27, so that, that's just $40,000 is a reduction of my income in that year.
Right.
And then in the next couple of years, when I normally would have been giving, I don't give, or I use that donor advised fund to distribute, but I take the regular standard deduction.
Yep.
My total tax savings is bigger than had I just spread it out over that time frame.
Another thing to consider on years like this, where we've had some pretty good market performance the last couple of years, is gifting appreciated securities.
Right. Yes. And again, calendar years matter in what year you're trying to offset taxes. But you're right. In a year like this, if you don't sell the stock to give the cash to them, but you give them the security itself, that gain we just talked about is not taxable to you.
Correct.
And the nonprofit, because they don't pay tax, is also not taxed on that.
Yeah, it's a double whammy.
It's a great way of giving. And then the last thing with the charitable giving is every year for anybody who has required distributions, giving it directly to charity, which is called a QCD, Qualified Charitable Distribution. You have up to $100,000 per year you could give out of this. That is also a non-taxable event. So if by the end of the year, you have to take your required distribution. And if you're saying, I really don't want any more income, I really don't need this cash myself, giving to a charity is a great way because it's not going to count towards your income, and it's cheaper from a tax standpoint to give them from your IRA than to give them cash from your investment account or from your checking account.
Yep. All right, let's take a break. We're 5 down, 5 to go.
Yes.
I have a dad joke of the week, Josh.
Okay.
It's more of a thought. This is a thinker.
Okay. All right.
Ponder
Think
this
about
with
it.
me here. I only know 25 letters of the alphabet.
No.
I don't know why.
You don't know why. Don't know why.
I don't know why.
Doesn't know
25
why.
to 26 isn't so bad, is it?
That's,
All right, we're back.
Passing
Number
grade.
6, it's a great time to be thinking about reviewing your insurance policies.
Yes.
And that can mean all kinds of insurance
yes,
policies.
across the board. Most people, and insurance are those things you hope to never need, but you need to have it there in case, like the emergencies. A lot of times people will set up as an automatic payment, and then just forget about it, which is great, except for periodically you just need to check back in with them, make sure they're still good.
Yep.
So we'll take a couple key ones just to look at. For instance, your home. So if you own your home, you have hopefully homeowners insurance. You need it. When you got it and set it up, the insurance agent probably did their due diligence of seeing your home value, size, square footage, and set the price correct. Well, over time, home values go up. And if you're not paying attention, your insurance coverage could get too low to be an effective coverage of the replacement of your home. So just got to periodically review that and maybe tweak it or adjust it. Or maybe you made some changes. Maybe you improved or did an add-on. Or maybe you added something that from an insurance standpoint is risky, like a trampoline. Those are things that will change your insurance. And if you're not adequately covered, the insurance company may say, you know what, you didn't tell us these things. We're not helping you.
Don't tell your
claims.
insurance companies about trampolines.
You need to tell your insurance companies about claims. I'm telling you this. You need to tell your insurance companies. But yes, those are things that would change it. Car, right? So did I get a new car? Did I add a new driver? Anything change with that? Those are a lot easier, straightforward, because you usually have to do that when you buy a new car.
Yep.
But just in general, do a quick review of that. And then you have, disability insurance, all the things to protect you, life insurance. Just end of year is a good time. Just do a quick look and say, okay, how much am I paying? Is that still the best one out there? You can always shop the different policies. Do I need to adjust the coverage? All those things.
Yep.
So insurance is always one that, it's best to set up and forget about it. But every once in a while, just do a little check-in.
A little check. All right, number 7, probably a good time at the end of the year to be thinking about checking your credit score. And we have a whole episode talking about credit scores. Yeah. So go listen to that. We'll link that in the show notes below. But Josh, why would you want to do that?
Yeah, so one, it's a safety net because your credit score shows all credit in your name. And so you need to pull your credit score periodically just to make sure there are no accounts out there that either you thought you closed and they're still open or were opened in your name that you didn't do, right? That's the fraud piece that you're keeping your eye on. Just recently, a lot of people's information got leaked because there was a data breach.
Yep.
And so now is even a more important time to periodically check in on this. Now, every year, you have the right to once a year ask for your credit from each of the 3. So you could actually do this 3 times a year if you wanted, one from each. But we encourage you at least annually. Pull your credit report, look through it, make sure everything lines up. If there's any errors or anything, you got to reach out to them. The 3 companies are Equifax, Experian, and TransUnion.
True.
Yep. And you can go online. They make it very easy because it's a requirement. Right. So they make it easy for you to pull it. They don't sign up. You don't have to pay for anything to get these.
Yes.
They offer plans and programs and all these things. They're not bad, but you don't have to pay anything to get your free report.
Right.
They'll offer like monitoring and coverage. Again, if that's something you need, great. But for your free annual report, it's free.
Yes.
All right.
Number 8. It's a great time to be sitting down with your spouse or whatever and when you're going. This is kind of related to number 1. When you're going through
back
your budget,
to budgets.
Look at your recurring expenses, recurring payments that you have going on. So think about streaming services are probably the one that comes to mind the most right now.
Subscription
service.
This
is something that my wife and I sat down and we're like, at one point, do we need all of these? Because think about this. There's only so many hours in a day. There's only so many hours you're not working that are available to be watching streaming services. And then there are actually less than that of how many you probably should actually be using. So then we said, wow, there's more than I can ever watch on one of these things. Do we need 5? No, maybe we can have 2.
Yeah.
So be reviewing those recurring expenses because they add up quickly, and you can save hundreds of dollars a year by canceling a couple of them.
And you may even not realize you're still paying for something because
using it.
You set it up and you just forgot about it. That I think that's probably why some of those gyms are still in existence is because you set up and it's super cheap and you just kind of
Planet Fitness, $10 a month. Yeah. You know how many people have that $10 a month and don't use it?
Yep.
It's a great business for them.
Yep. So recurring payments are just important. It'll help with your budget. It also helps you with your spending, just tracking it. Sometimes it's just a convenience to sign up and you forget about it and it's there.
Yep, absolutely. All right, Josh, number 9 and my second favorite.
Yes.
One of them. Review
your
investments.
Yep. So again, depending on who you are, your personality, kind of your engagement with this type of thing. There are some people who watch their investments daily. There's some that every month when they get their statement, they'll look at it. And there's some that never look at it.
Yeah.
And I'm suggesting that at least annually, do a quick look. And I'll list a couple things in particular to look at. One of which is for especially people who have retirement accounts at work, you probably have a list of investment options. And periodically, the 401k, 403b, whatever your retirement plan is, may change those investment options. And if you're not paying attention, your investments may change on their own to things you may not know you have or may not be the allocation you want. So review your options, review what you're invested in, and make sure those still make sense. Look at how much you're saving and make sure that that still makes sense because, again, raises, all those things, we encourage you to slowly work that savings level up. Review it with your goals. So you may have started with maybe being super aggressive because you had a long time horizon. Well, maybe you're closer to retirement. You need to review that. Is this still the same investment strategy I should have? So compare it to that. When you're looking at your other accounts outside of retirement, have those goals changed? Maybe I was saving for a down payment on a house. Well, now I'm ready.
Right.
I don't want to be super aggressive because I need that cash soon, but you take a little risk off the table.
Absolutely.
So look through those. I always say understand what you have and why you have it. If you can answer those 2 questions, then you're in a pretty good spot.
And Josh, finally, last but not least, number 10.
Yep.
Meet with your financial advisor. Probably a good idea.
Yeah.
At least annually.
Yes. It doesn't have to be at the end of the year, but at least annually. We encourage everyone, if you have a financial advisor, to schedule time to talk with them. Could be on the phone, could be on Zoom, could be in person, however you like to do it. But the idea there is they have a lot of expertise. Make sure you're utilizing them in answering a lot of these things I was talking about, right? They can help you along with that. If you say, hey, I'm putting 10% in my 401k, should I raise that up? And then they can help you look at your goals and say, well, you know what? You do need to increase your savings to get to these goals.
Right.
And then along with that too, we just kind of touched the surface on some of these planning things. We didn't talk about Roth conversions, which are a tax strategy of when you pay tax of withdrawing out of a 401k or IRA and moving into a Roth. There's a lot of nuances. That's where a professional comes in and talk with them about what makes sense, where you're at, and what you're trying to achieve. And if you don't have one, hey, maybe now's a good time at the end of the year
always a good time
to talk with them and say, hey, here's how things went. Could I have somebody with expertise make that even better? Give me a more strategic approach to trying to achieve my goals. And so talking to advisors is great.
And if you don't have an advisor, talk to us.
Yes.
You can reach out to us at hello@theinvesteddads.com or check out the Invest With Us tab on our website, theinvesteddads.com. But Josh, thank you for this list of 10 things we can think about towards the end of the year. The end of the year just kind of is a great opportunity to have a little bit of reflection, a little bit of a sense of where we were, but it is always important to know about where we're going, and we are going somewhere really cool, right? So
2025, that's where we're going.
2025, we're going to 2025. So we would like to announce that we are gearing up for a whole new look here in 2025 at the Invested Dads here, Josh and I. Our podcast is going to be undergoing a bit of a rebrand, and we can't wait to bring you fresh new content in 2025. So this is actually going to be our last episode as we are currently structured for 2024 with just Josh and I doing our thing like we've done for, hundreds of episodes. But in the meantime, make sure you're subscribed so you don't miss a thing, and we'll also still be active on our social media, so stay tuned there. Otherwise, hey, thank you for being you. Thank you for listening. We're appreciative of you. Please have a great holiday season, and we'll see you in 2025.
All right.
Bye.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.